So I think the major risks are these energy shortages that we're seeing, which is kind of the catalyst for stagflation. We also have to see how different central banks start dealing with the fact that they have inflationary environments. And so one of my big themes going into this year was that we probably would get substantial inflation, but yields would still be pretty low because that's essentially what happens when you have public debt as high as this is. The risk is that if they do try to tighten, which they very well might, that could obviously put some downward force on risk assets across the board, and that goes back to this thing where inflation is rarely a straight line. There are all these pushbacks against it that happen along the way, and so investors have to make sure that they understand their time horizon if they're a trader or an investor. So I view real interest rates as likely being, negative for a long period of time. Whether or not they go lower than now, I think is hard to say. But I think my key thesis is that they'll be persistently negative, and that there's obviously a certain risk that they go lower. So one of the things we're seeing in the United States, for example, is that shelter inflation is picking up, and so rent inflation and owner's equivalent rent inflation, they have not been large contributors to that initial inflation spike we had, but they're now driving a lot of it. And so they're about a third of that CPI basket. And so that's part of why it's going to be sticky going into 2022. And then of course from there we have to see what happens with the energy cycle, with some of these other demand sources and supply chains. With the Fed, for example, they've already indicated the order that they want to go in. They want to taper asset purchases, and then they want to be slower to raise rates. And they also, I mean, they have that reverse repo facility that's full, and they have normal repo facilities ready to go should that spill back the other direction. And so they've clearly set a foundation where they want to try to tighten, and yet they still have these buckets to absorb either periods of excess liquidity or insufficient liquidity. And so I think they've designed about as good of a system they can get for at least an attempt at tightening. The Fed doesn't always follow its own forecasts over time, especially as you get rotations in who is in charge of those decisions. But overall, I think the long and short of it is that we're probably going to mirror the 1940s in the sense that even if they do raise rates, it'll be kind of like too little, too late. Like if they start putting in 25 basis point raises into interest rates while inflation is 3, 4, 5, 6%, that's not going to do a lot to quell inflation, I think. So they're basically going to be behind the curve, and a lot of it is by design because with debt as high in the system as it is, they don't really have a lot of options. So not in the near term, that's not my view at all. My base case for a while has been inflation, so higher inflation than we've seen for a while, which is in 2021 we've started to see. Now, if you you kind of put your philosophical hat on and think really long term, fiat currencies have historically not lasted very long. This is also the first time in history, the past 50 years that the entire world's been on a fiat currency standard. And so we are in somewhat of an experiment here. And so I don't think anyone should rule out loss of confidence in currencies. But right now the conditions for hyperinflation are not present in developed countries. And so, for example, if you look at the broad money supply in the United States, it's currently going up by about a 13% annualized rate, which is elevated, but it's by no means what you see in say some of those emerging markets that are having major currency failures. And so I can imagine some scenarios that can lead to a hyperinflationary event. But I think it's premature to talk about hyperinflation with the conditions that we're seeing now or in the near future. Whereas with Bitcoin, for example, we saw that during shocks in the market, it can diverge significantly from what you'd necessarily expect. And so I wouldn't necessarily call it a hedge in the trading sense, but in terms of say a long-term place to put capital, if you are worried about inflation, I think at least Bitcoin has had a long enough track record of functioning well, doing what it's supposed to do, what it's designed to do, and achieving a sufficient network effect. And so when we look at Bitcoin, the complicating thing there is that because it's still young, it still has high volatility. Store of value becomes kind of a controversial term for it because generally, with a store of value, your mind naturally goes to low volatility. And so the way I describe Bitcoin is that it's an emergent store of value. It's basically a new technology, a new type of money, and it's currently finding its place in the market. So this past kind of call it 12 years, 13 years has been Bitcoin rapidly coming up to whatever market cap it's going to eventually kind of settle towards, or percentage of global asset it's going to settle towards. Whereas gold, for example, is an established store of value. So I think Bitcoin is on track to likely becoming store of value. But basically, you're in the earlier stage of investing in the idea that it's going to go through that S curve and become a store of value. So I think emergent store of value is probably the closer way to think about it. I think it certainly could happen. There are a couple factors that I think are different this time. Because remember, that's a pretty small sample size. Bitcoin's been around for 12, 13 years, and it goes through these 4-year halving cycles. So those winters occurred kind of in the second half of a halving cycle, and so we're talking about a sample size of like three. And so I think when we extrapolate that out, we have to be aware of a couple differences. One is that as Bitcoin has kind of reached the later stages of its distribution, right? So in those earlier markets, that the amount of new supply of Bitcoin was still pretty high, whereas because of those supply flow halvings, almost 19 million Bitcoin already exist, and the other 2 million are the ones still to be distributed. And so those halvings, I think, will matter less and less going forward. We're also seeing that, for those prior cycles, the amount of Bitcoin on exchanges kept increasing. So there were kind of local periods where it would go down a little bit, but generally you had a structural, persistent increase in the amount of Bitcoin on exchanges during both bull and bear markets. Whereas ever since around March 2020, we've seen a pretty persistent drain in Bitcoin from exchanges, and that's kind of partially tied to the fact that we're kind of near the end of its supply distribution. At least it's going to be distributed out for about 100 years still, but it's asymptotic. So we increasingly get the majority of coin distributed, and so that changes the supply demand constraints. The last thing I'd point out is that because of the way that mining has shifted, so it used to be these small operators, many of them in China, but as we've shifted more towards professional operators, and as we've gone into North America, especially publicly traded companies, a lot of them have better access to capital, so they can issue equity, they can issue loans that are backed by their Bitcoin collateral. There are a lot of institutions in the space that over the past 2 3 years have studied the space. They know how to lend to miners now. They feel comfortable with that risk. They have that specialization, and so because of that better cost of capital, a lot of miners don't ever have to sell their Bitcoin. So we have publicly traded miners where their goal is to mine Bitcoin and then hodl it. And so that somewhat changes also that 4-year supply, halving cycle. And so I think whether or not we get a crypto winter will partially depend on how euphoric it gets in the first place. So in those prior crypto winters, you got extremely high euphoria in Bitcoin and other cryptos. Whereas I think here you've not, by most indicators, you've not seen Bitcoin reach those lofty heights of euphoria that you've seen in prior highs. But if it were to get to a very high level, I do think you'd have a longer cool off period. I just don't know if it would last kind of the same length of time. It really depends on it's more about demand in my view, whereas supply is already getting pretty interesting how tight it is.